Hey, welcome to Street.Smarts, where you learn what school forgot to teach you. Today we're diving into the S&P 500, a simple, powerful way to invest in America's biggest companies. It's not just a stock ticker, it's a blueprint for building wealth. So, what is it? Why does it matter? And how can you start using it today? Let's break it down. What is the S&P 500? To understand the S&P 500, we've got to zoom out for a second. A stock market index is just a list of companies grouped together to show how the market's doing. Think of it like a scoreboard for the stock market. The S&P 500, short for Standard & Poor's 500, tracks 500 of the largest public companies in the US across 11 sectors. Together, they make up about 80% of the total US stock market by value. You can't buy the index itself, but you can invest in it through something called an ETF or index fund. Think of an ETF and an index fund like a shopping basket full of stocks. Instead of picking one, like Meta, you're grabbing all 500. It's like owning a tiny slice of the entire US economy. But not every slice of the S&P 500 is the same size. Some companies take up more of the pie because they're worth more. That total value is called market cap, short for market capitalization. Market cap is just a way to size up a company's total value. Stock price multiplied by the number of shares equals market cap. Raise the price or issue more shares, the market cap climbs. Drop the price and the value falls. Some companies split into billions of tiny shares. Others keep just a few big ones. So a high share price doesn't always mean a huge company. What really matters is the total value of all its stock. That's market cap. Companies come in different sizes. Mega caps are worth over $200 billion. These are the giants. Large caps fall between 10 and 200 billion, still huge and pretty stable. Mid caps are between 2 and 10 billion, often growing fast. Small caps are worth 300 million to 2 billion, riskier but full of potential. And while the S&P 500 gets the most attention, it's not the only index out there. First up, we have the Dow Jones Industrial Average. It tracks 30 of the biggest and most established US companies across industries like healthcare, manufacturing, energy, and consumer goods. Mostly large and mega cap players. But here's the twist. It's price weighted, so a stock's price tag moves the index more than its size. It's a snapshot of America's economic core, but with just 30 stocks, it's not the full picture. Next up is the Russell 2000. It tracks 2,000 smaller, fast-growing US companies. Newer, riskier businesses that aren't household names yet. It's used to track how the small cap segment of the market is performing. And then we have the NASDAQ 100. It tracks 100 of the largest US companies outside of finance, mostly tech, consumer, and healthcare giants. Made up of large and mega cap stocks, it skips banks and leans into fast-growing industries, making it more tech-heavy than other indexes. And that's just a few. There are dozens of indexes around the world. And get this, the S&P 500 alone makes up nearly half of the world's total stock market value. So how does it actually perform? Let's use some easy math to show you how this works. Over the last 100 years, the S&P 500 has returned around 10% per year. Not every year, some are up, some are down, but that's the long-term average. Now compare that to a rental property at 8%. That's cash flow and appreciation. A bond at 4%, or a savings account at 0.5%. Let's say you invest $100 a month for 30 years. Here's what you'd end up with. In a savings account, about $40,000. In a bond fund, around $69,000. In a rental property, around $149,000. In the S&P 500, about $226,000. That's why so many people choose S&P 500 ETFs and index funds. You get built-in variety, steady returns, and no guessing. Okay, let's put this to work. To invest in the S&P 500, you'll need a brokerage account. That's just a service that lets you buy and sell investments. Apps like Fidelity, Schwab, and Robinhood make it easy to get started. Here are 3 simple ways to make your first move. ETFs, exchange traded funds. These are bundles of the top 500 stocks, like owning a tiny slice of the whole market in one click. Popular options like VOO from Vanguard, SPY at State Street, and SCHX from Schwab trade like regular stocks, usually with no commissions and super low fees. Next up, we have index funds. These work a lot like ETFs, but are usually used for long-term investing inside retirement accounts like IRAs or 401ks. Popular options include VFI-AX from Vanguard and FXAIX from Fidelity. Most have small annual fees, but no monthly charges. And then we have fractional shares of S&P 500 stocks. Fractional shares let you buy just a slice of a stock in companies like Microsoft or Nvidia. So instead of paying full price for one whole share, you can invest with whatever fits your budget. You still ride the same growth and gains, but just on your level. It's the smarter way to start investing without waiting to save up. Quick side note, other tools like bonds, treasury notes, or options can also play a role in your portfolio. They work differently than index funds, and we'll cover those soon too. Now let's look at how investing in the S&P 500 can play out in real life. Meet Sam and Jamie. They both start investing at age 25. They both invest $200 a month. That's $2,400 a year. And they both keep it going all the way until age 60. That's 35 years of investing for a total of $84,000 each. But here's the key difference. Jamie parks their money in a basic savings account, earning just 0.5% interest, while Sam puts the same monthly deposit into an S&P 500 index fund, averaging 10% per year. So who comes out on top at age 60? It's traditional savings versus index funds. Let's run the numbers. Jamie played it safe with the savings account. After 35 years, their $84,000 grew to about $90,000. Now let's look at Sam. Same $84,000 invested, but in the S&P 500. By age 60, Sam's total grows to about $750,000. Same monthly deposits, same time frame, same total invested, but Sam ends up with more than 8 times as much. Start early, add consistently, but it's all about investing in the right place. Want to see which investment builds more over time? These tools compare S&P 500 returns to bonds, savings, and more using your own numbers. First out the box, we have Smart Asset Investment Growth Calculator, a free beginner-friendly tool that shows how your money grows over time. Enter your contributions, return rate, and timeline to instantly compare outcomes for index funds, ETFs, or savings accounts. Next up, Bankrate Investment Calculator, a simple, modern calculator that maps out your investing path using your monthly deposits, target return, and long-term goals. Test different return rates, run quick what-if scenarios, and see how small contributions add up. Then we have Investor.gov Compound Calculator, a free, safe, government-built tool that shows how your savings or S&P 500 investment grows over time. Ready to run the numbers? All the tools and calculators we mentioned are linked below. Fast, easy, and yep, it helps support the channel too. Here's where most people slip up and miss the real gains. They rely on a few hand-picked companies instead of the broader market, where one bad move drags everything down. Instead of sticking to a plan, they react to every headline, selling on fear and buying on hype. They rush in late on trends, and by the time they buy, the excitement is already priced in. They sit on the sidelines trying to time the market and end up missing years of real growth. When things get rough, they panic and bail out, locking in losses that could have recovered. They jump from one plan to the next, never sticking with anything long enough to see results. And here's the crazy part. If you miss just the 10 best days in the market over the last 20 years, your returns would be cut in half. That's what happens when you try to time the market. You miss the moments that matter most, because time in the market beats timing the market. The S&P 500 is powerful, but that doesn't mean it's perfect. It goes up most years, but not every year. 2008, down 38%. 2018, down 6%. And 2022, down 19%. If you panic and sell during a down year, you lock in losses before the market has a chance to bounce back. That's where safer tools like bonds and treasury notes come in. They don't grow as fast, but they're steady. And in rough years, that safety matters. So what's the move? If you're young and can ride the ups and downs, S&P 500 all day. But if you're closer to retirement or need stability, mix in bonds to protect your balance. It's not all stocks or nothing. It's about building the right mix for your goals and your timeline. Lesson locked. The S&P 500 is simple, powerful, and proven. One move, no guessing, no gambling. The market has been creating millionaires for decades. All you need is a plan and time. Real quick, everything in this video is for education and entertainment only. I'm not your financial advisor, doctor, or lawyer, so always do your own homework or talk to a pro before making big moves. That's a wrap. Today you learned what the S&P 500 is, how it works, why it's one of the smartest investing tools around, and how to use it the right way for your goals. Like, comment, and subscribe. Smart moves begin with you. Let your money and time handle the compounding. The S&P 500 takes care of the rest. You learned it here. Now put it to work. That's Street Smarts.